Welcome back to Investing Talk Podcast. We're here to help you cut through the noise, giving you clear, actionable insights into complex topics tailored just for you. Today, we're diving into a question many of you, our curious learners, might be pondering in the current market. Is Occidental Petroleum a good time to buy now? It's a company that frequently makes headlines, and for good reason, given its significant footprint in the global energy sector.
That's right. For this deep dive, we've poured over a pretty comprehensive investment and trading analysis of Occidental Petroleum. We're covering everything from its, underlying financial health to intricate market sentiment and potential future catalysts. Our core mission here is really to distill all that data into a clear, actionable understanding so you can truly grasp what's unfolding with this stock and, most importantly, what it might mean for your portfolio.
Absolutely. We're going to thoroughly explore whether Occidental Petroleum presents, well, a compelling opportunity for short-term traders, maybe looking for quick gains, or perhaps a more strategic play for long-term investors. We'll peel back the layers on its fundamentals, valuation, technical signals, and crucially, the risks involved. It's about getting past the headlines and straight to the core of what you, our listener, truly need to know. Before we dive deeper, if you're finding these deep dives valuable and enjoy gaining this kind of clear, thorough understanding of complex topics, please consider subscribing, liking, and maybe leaving us a comment. Your engagement truly helps us bring more of these insights directly to you. And if you're feeling extra generous, you can always consider buying us a coffee. It definitely helps fuel these deep dives. Okay, let's unpack this company from a foundational perspective. When you looked at the analysis, what did it reveal about Occidental Petroleum's core business health, especially given its specific role in the energy market?
Right. So when we dive into the fundamentals, what immediately stands out is that Occidental Petroleum is an independent exploration and production company, an E&P company. Now, this isn't just a label. It really defines their entire business model. Unlike the big integrated oil majors who handle everything from drilling right through to refining and marketing, Occidental's primary focus is solely on finding and extracting oil and gas. And this means their revenue and, crucially, their profit margins are, they're inherently volatile.
Okay.
Think of their earnings like a wild roller coaster, basically soaring and plummeting directly with the unpredictable whims of global crude oil prices. That direct exposure to commodity price swings makes consistent profitability a constant sort of uphill battle for them.
That distinction makes a lot of sense. So given that inherent volatility, how robust is their financial backbone to handle those swings? Specifically, what did the analysis reveal about their debt burden and, crucially, their cash flow? Those are often the true indicators of resilience, right?
Yeah, exactly. The analysis highlights a pretty significant debt burden for Occidental Petroleum. And this is a critical point because, high debt isn't just a number on a page. It fundamentally limits a company's financial flexibility. It means a larger portion of their earnings has to go towards servicing that debt, just paying the interest rather than being reinvested into growth projects or acquisitions or even returning capital to shareholders. This gets particularly challenging when market conditions soften.
Right.
On the flip side, robust, positive cash flow is absolutely vital for them. They need it to service that debt and still have enough left over to reinvest in their operations, explore new fields, maintain infrastructure. Recent trends show that their cash flow has also been quite variable, sort of mirroring the same fluctuating market conditions we just discussed.
Okay.
Which, adds another layer of complexity to managing that debt.
And here's where it gets really interesting on the earnings front. You mentioned volatility, but what do the recent results and maybe more importantly, future projections suggest for their profitability?
Well, this raises an important question about expectations, right? Occidental Petroleum recently delivered an impressive earnings per share surprise. They hit $0.87 compared to analyst estimates of $0.80.
Okay, that's pretty good.
Yeah, it's a solid beat. It signals some immediate operational efficiency. However, and this is key if we connect this to the bigger picture, the forward-looking projections tell a rather different story. They indicate a significant decrease to around $0.37 per share in the next quarter.
Wow, quite a drop.
Exactly. And this contrast, a strong earnings surprise followed by a weaker future outlook isn't just a detail, it's a critical flag for investors. It suggests that while recent good news might be a bit of a one-off, future profitability could face some pretty significant headwinds.
Like what? Lower oil prices, maybe?
Possibly lower oil prices, could be higher operating costs, other market shifts. It just tells us to look beyond the immediate headlines and really dig into that long-term earnings trajectory.
So despite their scale, it sounds like they're operating in a very challenging environment. How does Occidental Petroleum really stack up within this intensely competitive oil and gas sector?
Yeah.
Are they holding their own against the giants?
Well, they operate in an intensely competitive landscape, no doubt about it. While Occidental certainly benefits from its scale and its geographically diversified operations, they aren't just tied to one region, which is good.
Right.
It's constantly battling against much larger integrated players. Think ExxonMobil, Chevron. These larger competitors often have, well, deeper pockets, more diversified revenue streams from refining and other downstream operations, and greater economies of scale.
So it's tougher for Occidental.
It means Occidental has to be incredibly efficient and strategic just to maintain its market share and profitability, especially when price wars erupt or new technologies emerge. It's a constant fight for every barrel, really.
Knowing their financial volatility and these competitive pressures, it's crucial to see how the market prices all that risk and opportunity.
Yeah.
So let's turn to their valuation. How does the market actually value Occidental Petroleum right now? Are investors seeing a bargain, or is it maybe fairly priced considering its challenges?
Okay, valuation. When we look at the metrics, the price-to-earnings ratio, the PE, is sitting around 11.84. Now, for those maybe less familiar, the PE basically tells us how much investors are willing to pay for each dollar of the company's annual earnings.
Right.
A PE of 11.84, when you compare it to some of its peers in the energy sector, it's relatively lower. This could suggest that the market is perhaps undervaluing Occidental's earnings power right now. Essentially, you might be getting more earnings for your dollar compared to some competitors.
Okay, interesting. What about price to sales?
The price to sales, or PS ratio, that stands at 1.55. This measures the company's market cap against its total revenue. And like the PE, you really need to weigh this against industry averages to truly assess its relative value. Is it a discount or a premium compared to its sales level?
But the really compelling part here, I think, is the fair value assessment you mentioned from the analysis. Isn't that right? That seems to cut right to the core of potential opportunity.
Absolutely. Yeah, if we connect this to the bigger picture, according to a detailed analysis by Morningstar, Occidental Petroleum is currently trading at what they call a significant discount to its estimated fair value.
Significant.
Yeah, significant. And this is a powerful finding because it implies that, based on a comprehensive fundamental analysis of its future cash flows and intrinsic worth, the stock should theoretically be trading at a higher price. This specific finding is a pretty strong signal that there might be substantial upside potential, particularly for, long-term value investors.
The patient one.
Exactly. Those who believe the market will eventually recognize this intrinsic worth and price the stock accordingly. It's a bit like finding a dollar bill on the ground when others maybe only see loose change.
Okay, we've looked at the underlying health and the market perception, but what about the immediate pulse of the stock? What are the charts telling us about Occidental Petroleum's recent price action? And are there any critical technical signals we should be watching for traders and investors?
Right, the technicals. From that standpoint, Occidental has indeed shown considerable volatility, no surprise there. Its price movements often closely mirror the broader oil market fluctuations. You just look at its 52-week range, a low of $34.79 to a high of $64.76. That really underscores the significant price swings.
Yeah, that's quite a range. Not for the faint of heart, as they say.
Definitely not. It's more like a wild bull ride than a gentle stroll.
And what about the trend? Are we seeing any clear direction from those key moving averages that so many traders rely on?
Well, what's fascinating here is the relationship between its moving averages. The 50-day simple moving average, which reflects shorter-term price momentum, is around $42.34. In contrast, the 200-day SMA, indicating the longer-term trend, is up around $47.26.
Okay, so the short term is below the long term.
Exactly. And when the shorter-term average, the 50-day, dips significantly below the longer-term one, the 200-day, as it has here. It's often interpreted as a bearish signal, sometimes called a death cross.
Right.
This confirms that the stock's recent momentum is indeed pointing downwards. It suggests a clear trend towards lower prices, at least in the near to medium term. However, and this raises an important counterpoint, the Relative Strength Index, or RSI, which is a momentum oscillator, is currently quite low, around 26.88. Now, this level is widely considered to indicate oversold conditions.
Meaning it might have fallen too far, too fast?
Potentially. It suggests the selling pressure might be overextended and a technical rebound could be on the horizon. But, while not a definitive buy signal on its own, it's something technical traders watch closely.
So, a potential bounce, But the bigger trend is still down based on those averages.
Precisely. It's a mixed technical picture, which adds to the complexity.
Okay. Beyond the raw numbers and chart patterns, how is the broader market feeling about Occidental Petroleum right now? What's the latest buzz or the news influencing overall investor sentiment?
Well, the notable takeaway from the sources we reviewed is that analyst sentiment has been quite mixed. The general consensus seems to lean towards a hold rating for the stock, not a strong buy, not a strong sell.
Kind of neutral then.
Pretty neutral, yeah. And we've actually seen more downgrades than upgrades recently, which can definitely impact overall investor confidence and might contribute to that downward price momentum we saw in the technicals.
Right.
Interestingly, the reports haven't highlighted any significant insider buying or selling activity.
Which can sometimes be a signal.
Exactly. It can often be a strong signal of confidence or lack thereof from those closest to the company. Its absence here is, well, it's neutral again, perhaps. Nor has there been a major social media buzz or unusual retail investor activity noted, suggesting sentiment is largely driven by institutional analysis rather than, say, meme stock type chatter.
Okay, so looking ahead, what are the big events on the horizon that could affect Occidental Petroleum's trajectory? And perhaps even more critically, what are the major risks investors should truly be aware of before considering this stock?
Sure. Key upcoming catalysts definitely include their quarterly earnings reports. As we saw with the recent surprise, these can cause pretty significant price swings based on performance relative to expectations.
Always a big one.
Always. Beyond that, broader macroeconomic developments are huge. Things like changes in global energy demand due to economic growth, or conversely, recession, or potential supply chain disruptions impacting their operations. These will directly affect their profitability. And of course, OPEC decisions on production quotas are always a massive variable for any E&P company, as are any shifts in global political stability. Very sensitive to that. Now, regarding risks, this raises an important question about what potential investors should really brace themselves for. There are several layers here.
Okay, let's break them down.
First, you have stock-specific risks. The primary one is that high volatility we keep mentioning, tied directly to oil price fluctuations. Sharp, unpredictable swings are just part of the deal. Then there's that significant debt burden we talked about. It acts like an anchor, limiting financial maneuverability and increasing vulnerability during market downturns.
Got it. What's next?
Second, sector-specific risks. The intense competition within the oil and gas industry means constant pressure on margins and market share. Regulatory changes like stricter environmental policies or new drilling restrictions could directly impact their operations and costs. That's a big uncertainty. And of course, growing environmental concerns and ESG, environmental, social, and governance pressures from investors can influence capital availability and public perception.
Right, ESG is becoming increasingly important.
Absolutely. Finally, there are the broader macroeconomic risks. Global economic downturns directly reduce energy demand. That hurts everyone in the sector. And geopolitical tensions, conflicts, trade wars can severely disrupt energy markets worldwide, creating both massive price spikes and crashes. It's truly a complex web of interconnected risks you have to consider.
All right, so after sifting through all this data, the fundamentals, the valuations, the technicals, the sentiment, the risks, what's the overall assessment for Occidental Petroleum right now? Is it a good time to buy? What's the bottom line from the analysis?
Well, the analysis gives Occidental Petroleum an overall rating of 6 out of 10.
6 out of 10. Okay, that's not screaming buy, but not terrible either. How should we interpret that?
Exactly. It's not a simple buy or sell signal. It's definitely a nuanced assessment that requires a bit more interpretation based on your own investment style.
So what does that 6 out of 10 mean for different types of investors? Is this a stock for the quick, opportunistic trader, or is it more suited for the long-term holder?
Yeah, what's fascinating here is the clear distinction the analysis makes. For short-term trading, it suggests Occidental Petroleum is probably not ideal.
Why is that? Because of the volatility.
Primarily, yes. Its inherently high volatility, while sometimes creating opportunities, also leads to really unpredictable swings that can quickly wipe out gains if you're not careful. And while those technical indicators like the RSI showing oversold conditions might hint at a potential short-term rebound.
Right, the bounce potential.
Relying solely on that for quick trades is pretty risky, especially given the broader downward trend signals and the mixed sentiment. It's a bit like trying to catch a falling knife, as they say.
Okay, so maybe not for the day trader. What about longer term?
However, if we connect this to the bigger picture, the analysis suggests it's likely more suitable for a long-term investment, particularly for value investors. These are individuals who are patient, who can look beyond the short-term fluctuations. They see potential in the broader energy sector's eventual recovery and, crucially, in Occidental Petroleum's current significant discount to its estimated fair value that Morningstar identified. For them, that 610 rating signals a company with potentially strong intrinsic value, but one that definitely comes with a significant amount of turbulence. It's for the patient, risk-aware investor, not for those looking for a smooth, short-term ride.
And for those long-term value investors who might be interested, who fit that profile, are there specific price points the analysis suggests for getting in, and just as importantly, for managing the risk?
Yes, the analysis does provide some strategic price points to consider. It suggests looking at a potential buying range around $38 to $40.
Okay.
This range sort of acknowledges the current downside risk we've discussed, but also positions an investor to potentially benefit from that recovery, aligning with the fair value discount idea.
And managing the risk.
Yeah.
Stop losses.
Absolutely crucial. For risk management, a stop loss around $35 is suggested. This acts as a safety net, basically designed to limit losses if the price continues to decline and maybe breaks through a key support level.
Makes sense. And on the upside, any targets?
Yes, for an upside target, a take-profit level of around $55 is suggested. This aligns with some analyst targets out there and offers what seems like a reasonable potential upside for long-term investors who are looking for a significant return, assuming the market starts recognizing that intrinsic value and the energy sector stabilizes.
So what does this all mean if we distill it right down? It sounds like a deeply nuanced picture, not a simple yes or no.
Indeed. It really is. While Occidental Petroleum certainly presents some clear risks, particularly its inherent volatility tied to oil prices and that significant debt burden. The analysis indicates it may offer compelling value, but specifically for long-term investors. These are investors who possess the patience to ride out the market's turbulence, who believe in the company's underlying recovery potential, and who are, reasonably confident in the broader energy sector's stabilization and long-term demand. It's really about aligning your personal investment horizon and risk tolerance with the stock's fundamental characteristics.
Wow, that was a truly comprehensive deep dive into Occidental Petroleum. It's truly eye-opening how many different threads, from global oil prices to balance sheets to technical chart patterns, all weave together to tell a company story like this. The complexity really is fascinating.
It truly highlights that there's always more to learn, doesn't it? And understanding these multiple perspectives, weighing the good with the challenging, it really enriches your entire approach to information and investment decisions.
So what does this all mean for you, our curious listener? We've unpacked why Occidental Petroleum isn't necessarily a slam dunk for short-term trading right now, but how it could present a compelling opportunity for patient value investors looking at the long game, particularly if they consider those strategic entry and exit price points we discussed.
And maybe this raises an important question for you to ponder as you look at any energy investment these days. How do broader geopolitical factors and, maybe more importantly, global shifts in energy policy, things beyond just pure market supply and demand, how do those play into your long-term view of a company like Occidental Petroleum? Are we on the cusp of major energy transitions that could impact even the most seemingly resilient players in the traditional space?
That is a truly thought-provoking question to chew on. Excellent point. Thank you for joining us for this deep dive. We really hope it's given you a clearer, more informed perspective on Occidental Petroleum. Until next time, keep exploring, keep questioning, and keep learning.